Lecture outline. So in this lecture, Dow Theory and Trend, we will start by discussing Dow Theory. We'll spend about the first 1/4 of the lecture doing this, and then we'll talk in the remaining 3/4 of the lecture about trend. And within trend, we'll first talk about what trend is and what it looks like, how it works, and then we'll talk about different tools that we can use to identify trends. So we have support and resistance, we have trend lines, we have channel lines, and we have retracements. So we'll go through each of these concepts, and we'll go through examples as well with actual charts so that we can understand exactly how they work and how they relate to helping us identify trends. Dow Theory. Okay, so let's start our lecture by talking about Dow Theory. Dow Theory is based on the writings of an individual investor named Charles Dow, and he was a very famous investor in the late 1800s, and he created the Dow Jones Index, the different Dow Jones indices. So when we look at the markets today, for example, in the US market we have the Dow Jones Industrial Index. Well, it's named after this guy, Charles Dow. He also created the Wall Street Journal, which is a very influential newspaper in the financial press. So that's Charles Dow. What about Dow Theory? Well, Dow developed many concepts and understandings about how markets work. And he essentially developed a theory of trends. And it really forms the start of technical analysis. So his theory is the first theory about trends and the first theory about technical analysis. And he also looked at sectors. So he also looked at how different sectors of the economy should interact with one another, and how different stocks of different sectors should interact. And as a result, it's created some of the other Dow indices. So we have the transportation index, we have a manufacturing index, all courtesy of Charles Dow. And out of Dow Theory, now as we said, Dow Theory is very old. It's one of the first technical analysis theories. There have been many newer and more complex forms of technical analysis. So what we'll see is when we go through Dow Theory, we'll see that it's fairly simple and fairly simplistic. And that's because it's actually one of the first theories out there. And what we'll see is that a lot of the newer technical theories that exist today that we use in practice, a lot of them originate from Dow Theory. And this is why it's so influential and so important. So even if it seems simplistic, it's important to remember that these are really the building blocks for the field of technical analysis as a whole. And just the idea that we can look at charts and we can look at trends and we can make decisions on how to invest based on these factors. Basic tenets. What forms Dow Theory are 6 tenets. Tenets are sort of statements of fact that the theory claims to be true. So Dow Theory is comprised of 6 of these, and these 6 of these tenets essentially describe how the market works. So we'll go through these one by one. The first tenet, the market discounts everything. What this means is that the price of a stock, i.e. the market price of a stock, already incorporates all the fundamentals about that stock, which implies that the market is efficient. So for example, if a company has particular earnings, it has particular features about it, this is all incorporated into the stock price. The second part of that is that the stock price also incorporates expectations about the future. So for example, if a company is expected to have earnings of X in the future, then this is already incorporated into the price of the stock. Now let's think about what the implications of this are. The implications are almost that fundamental analysis is not very useful, because what this tenet is saying is that the fundamentals are already incorporated into the price of the stock. So therefore, you cannot necessarily make money by learning about the fundamentals, because it's already incorporated into the price. Now this is a contentious point. Obviously many people would believe otherwise, but this is one of the cornerstones of Dow theory, and one of the cornerstones of a lot of technical analysis theory as well. So that's the first tenet: the market discounts everything. The second tenet: the market has three trends. Now we get a bit more into the technical analysis side of things, and according to Dow, the market has three different trends going on at the same time. There is the primary trend, which is a long-term trend, and this is normally measured in up to a year or multiple years. There is an intermediate trend, which we normally measure in periods up to 3 months, and there is a minor trend, which we measure in periods up to 3 weeks. And the relationship with the primary trend and the intermediate trend is quite important, because the primary trend, for example, will go in one direction. Let's say the primary trend of the market is up. Within that primary trend, there will be intermediate trends going the other direction, right? So intermediate trends may retrace between 1/3 to 2/3, and usually Dow estimated to be about a half of the previous move, right? So if a stock goes from 100 to 200 as part of the long-term trend, the intermediate trend might see it go from 200 to 150, right? Retracing half the move. And then minor trends are essentially very short-term trends, up to 3 weeks, or it can be a few days. And prices, the trends goes up and down regularly within that. Basic tenets. Now we'll talk about tenets number 3 and 4. Tenet number 3. The market trends have 3 phases. Now this is separate to what we said earlier about market trends, there being 3 different trends. Now we're saying that there are 3 phases to a market trend. And usually this will refer to the long-term trend, but doesn't have to. So the first phase is the accumulation phase. The accumulation phase is informed buying by intelligent investors. So this is when the intelligent investors who are highly skilled, know something about this stock, start buying. The second phase is the public participation phase. In this phase, news of the stock starts to spread, and the public begin buying at large. And once the public start buying, prices of the stock start going up. And this of course leads to more buying and prices continuing to go up. Then we get to the distribution phase, which is essentially the height of the boom, when the stock price has reached close to its highest levels. And this is when the informed investors that bought in the beginning begin to sell. And then after this, we'll see the price go down the other way. So that's tenet number 3. Tenet number 4. Market averages must confirm each other. Now when Dow talked about market averages, what he was referring to were different sectors of the economy. So for example, the Dow indices, which contain, for example, the Dow Transportation Index, the Dow Manufacturing Index, Dow Industrial Index. And what he said was that for any trend to be confirmed, the complementary sectors must move together, i.e. they must confirm each other. So for example, if we have manufacturing stocks rising, right, let's say we have an index of manufacturing stocks that's going up, because manufacturing needs railroads to have the goods move around. Okay, now we're talking about a particular time when railroads was the way goods moved around, maybe different now. But essentially, if manufacturing is doing well, then the demand for railroads should increase. So rail stocks should also be doing well. So if we see an uptrend in manufacturing stocks, we should confirm it by looking at the behavior of rail stocks. If rail stocks are also going up, then they confirm each other. But if one is going up and the other is not, then it could be a sign that this uptrend may not be sustainable. Basic tenets. Now we'll go on to the final 2 basic tenets of Dow theory, numbers 5 and 6. Basic tenet number 5. The volume must confirm the trend. Now in addition in addition to using the price, we can also use volume as an indicator to tell us about what's going on in the market. And Dow considered volume to be a secondary indicator to price, that is not as important as price, but still important. And what he said was that for a trend to be valid, the volume must increase in the direction of the trend, specifically the major trend. So if we see stocks going up, right, let's say the major trend of a particular stock or stock index is upwards, then for this to be valid, we need to see volume increasing as the prices go up. And conversely, when prices go down, we should see maybe less volume. Now, why is this important? Well, the more volume there is, the more market participants there are. So Dow believed that if prices move alongside rising volume, then it meant that the entire market was convinced by the price move. Right? So if there's an uptrend and there's lots of volume, high volume with that uptrend, it means that the market is convinced of that stock going up and being worth more. And what we should also look out for is that if a price moves without rising volume or it moves with falling volume, then it is more likely to be unsustainable. Okay? Straightforward enough. Finally, basic tenet number 6. A trend is in effect until definite signals that it has reversed. And this is one of the challenges of trend analysis and of Dow theory, is that we need to know when a trend has changed. Right? So if the primary trend is in a particular direction, we need to know when it changes. So according to Dow theory, we have to assume that a trend is in effect until there are definite signals that it is not. Right? So this is why we have the intermediate trend. So markets will move sometimes in the opposite direction. That's the intermediate trend. But then they will resume their prior uptrend in the primary direction. And unless we see a fall significant enough that it's no longer an intermediate correction, right? It falls below what will be considered an intermediate correction. If you remember, we talked about intermediate correction as being between 1/3 and 2/3 of the move. Until that occurs, we cannot say for sure that the trend has changed. And this is, of course, one of the many challenges, as we just discussed, and we'll go on to talk about it more later on. Trend. This now concludes our discussion of Dow theory. We'll now move on to the next part of the lecture, where we'll talk a bit more about trend. So when we talked about Dow theory, we talked about different trends. So now we're going to take a step back, and we're going to talk a bit more generally about what is trend. A trend essentially is the direction of the market, right? So we have the market's going up or the market's going down, right? So a trend is telling you the general direction of which way the market is moving. So let's think about this a bit more formally. How would we define it? Well, we know that markets do not move in a straight line, right? They zigzag, they go up, they go down. So if we look at any charts, what we will see is that we have peaks and troughs. So peaks are the higher points, so an up move followed by a down move. Trough is the lowest points, low move followed by an up move. And when we're thinking about what constitutes the market trend, what we want to look at is the direction of the peaks and troughs. So if the peaks and troughs are moving upwards, that's an uptrend. If the peaks and troughs are moving downwards, that's a downtrend, and so on. Now, trend is very important because most of technical analysis is concerned with identifying a trend and trading in the direction of that trend. Now, many of you may have heard a very well-known sayings like the trend is your friend, or always trade in the direction of the trend. And because if we do this, obviously we'll make money, right? If we have an uptrend and we trade in the direction of that uptrend, we can make money. Likewise with the downtrend. So really what we're going to be looking at when we do technical analysis is identifying trends. We're going to identify trends and try and trade to benefit from those trends taking place. Trend direction. So far, we have been talking about two different directions that a trend can be. Trend can be upwards, an uptrend. A trend can be downwards, a downtrend. And as we defined earlier, an uptrend occurs when prices are rising, and a downtrend occurs when prices are falling. There is, however, a third important direction. So trends can move in three directions, not two. The third important direction is what is known as a sideways trend. A sideways trend occurs when prices are moving horizontally on the chart and within a trading range. What this means is that during a sideways trend, the price stays within a particular range and doesn't really move up or down. Now, it's always the case, for example, that prices are changing, right? So prices are never constant at a particular point. But however, they can move within a range. So they can go up, they can go down, over a long period of time, not really change much, right? So this is a sideways trend. Now, it's estimated that markets can spend a significant portion of time just going sideways. That is, not moving up and not moving down. And this will vary by market. So some markets have a lot of uptrends and a lot of downtrends and very little sideways movement. Some markets have more sideways movement. So it's really up to us to determine which markets have more uptrends and downtrends and which markets have more sideways movement. Now, sideways trending is very important because if we look at most trend following systems, like Dow Theory is an example of this, they tend to do very well during uptrends and downtrends. So they're good at identifying when an uptrend is taking place and taking advantage of it. The same with a downtrend. However, they perform quite poorly during sideways trends. Right? So if the price is going up and then our trading system identifies at the start of an uptrend, if it's actually a sideways trend, then the price will just come back down after that. So we'll keep getting what is known as whipsaw, right? So trend following systems tend to do poorly during sideways trends. And this, I want to emphasize, a very important part of technical analysis and investing in general. So knowing when to stay out of the market, that is, i.e. whenever there is sideways movement, is as important as knowing when to enter the market during an uptrend or downtrend. So we need the tools to identify uptrends or downtrends. We also need the tools to identify a sideways trend. Because when we identify a sideways trend, then we know not to trade, right? Or adjust our trading strategy to benefit from a sideways trend. But not necessarily to do trend following, trying to play an uptrend or downtrend. So trend direction then is very important. Trend classification. Trends can be classified into major trends, intermediate trends, and near-term trends. The near-term, of course, is like the minor trend we discussed before. Now, we can have more classifications if we want to. So we can have 4 categories of trends, or 5, or 6. And in general, each of these will represent a specific time period. So the major trend is the longest, then intermediate is shorter than the major trend, and near-term is even shorter. Now, when we did Dow Theory was essentially a special case of this, because Dow identified major trends as being up to a year and more, intermediate trends being up to about 3 months, and minor trends being up to about 3 weeks. So Dow Theory was very specific about the time frame of the trend. But actually, if we look at it more generally, we can create time frames as we like. So our major can be 5 years, 10 years, intermediate can be 1 year if we want to. Or we can have major be 3 months and intermediate be a week. Right? It all depends. It depends a lot on the market we're looking at. So if we're looking at, for example, a futures market, because futures markets tend to be much shorter term, our major, intermediate, and near-term trends will be much smaller in length. Alright, so the first thing to know is that we can adjust these by the length that we want. And like with Dow Theory, this one principle is the same thing. So the intermediate trends represent correction in the major trends. So if the major trend is upward, an intermediate trend will be a downward correction of that upward trend. And of course, if it is just a correction, it is assumed that the price should continue back in the direction of the major trend. Now, what is the near-term trend? Well, within these corrections, or within the direction of the primary trend as well, we have short-term up and down movements, right? So market will go up for a few days, then fall for a few days, and this represents the near-term trend. And we generally don't use this that much. We tend to use the intermediate trend and the major trend in order to create our trading strategy. So a very common trading strategy is to trade in the direction of the major trend and time it to follow an intermediate correction in the trend. We discussed this a little bit earlier. Let's just think about how this would work. So if the major trend was upwards, I would then look for an intermediate correction, that is a downward correction, where let's say 1/3 to a half of the move is retraced. Right, so it's fallen by 1/3 to a half of what it gained before. And after that fall, I would look to buy the asset and benefit from its likely continuation of its previous major uptrend. Support and resistance. The next two concepts we will discuss are known as support and resistance. I'm quite sure that most of you have heard these terms before and likely use them yourselves. And if you have not, that's fine. We'll learn about it now. Support and resistance are fairly critical to technical analysis. They're one of the most commonly used tools and indicators. So let's discuss first what they are. We'll start with support. Support refers to a price level where buying interest is sufficiently strong enough to overcome selling pressure. So essentially, if we have a price, a support means that the price, when it reaches a particular level, it has some support. There's lots of buying interest at that level, which should prevent the price from falling further, right? The buying interest should overcome the selling pressure. And we identify support by looking at prior lows. Right? So if we look at when prices previously made a low and recovered, we can identify that as being a support, where there was a lot of buying interest. Resistance is exactly the opposite of support and works in the same way. Resistance refers to a price level where selling interest is sufficiently strong enough to overcome buying pressure. So now we're going to look at prices going up, and resistance occurs when lots of people start selling at a particular level that prevents the price from going through that level, i.e. there's a resistance to the price from continuing upward. And we usually identify resistance by looking at previous highs. So we will look at when did the price previously make a high and then come back down. Right? So if a price made a high and then came back down, that's an indication that there was strong enough selling pressure at that point to get the price to go back down, and therefore it is resistance level. Now, of course, these are not levels that cannot be broken. Right? Otherwise prices wouldn't go anywhere. In general, we expect that most of the time, the majority of the time, prices will bounce off the support or resistance levels. Right? So most of the time, if the price reaches a support, it should go back up. If it reaches a resistance, it should go back down. However, occasionally, prices will break through the support levels and will break through the resistance levels. And in the next slide, we'll talk a little bit about the implications of this. But this should hopefully give you a general idea of what is support and what is resistance, and how we can identify it in a price series or in a chart. Support and resistance. Let's now continue our discussion on this topic. So we talked a little bit about the fact that prices occasionally break through the support level or the resistance level. Now we want to talk a bit more about the implications of this. So when a price breaks through a support level or a resistance level, it then usually moves much further in the same direction. Okay? So for example, let's say we have a support at 100 and the price is falling. Now, when the price approaches 100, there may be strong buying pressure that prevents it from reaching 100 or crossing it. But if the price does in fact cross 100, then we should see a further continued drop, maybe towards 95, 90, or the next support level. Alright, so it's like a barrier, and if that barrier is broken, then you can travel much further. Let's think about why this might be the case. Well, support levels and resistance levels are used to place stop losses quite often. Now, because when a support level or resistance level is breached, stop losses get closed out, and this pushes the price further in the same direction. And let's think about an example of how this might work. So let's say, for example, you have a bunch of investors who have taken a long position in the asset and placed their stop loss just below a support level. Now, if something happens such that the price is strong enough to break through that support level, you will now all of a sudden get a large group of investors which have stop losses on their buy positions, meaning they're having to sell to close out those positions. And that act of large number of traders selling just below the resistance level to close out stops will lead to the price falling even further. And this is why when we break through a resistance or support level, we can see prices move significantly in the same direction, primarily because of where stop losses are placed. We often use the breaking of support or resistance to signal a new trend. So if the price breaks through a support level, we consider that now the price is now in a downtrend. And if it breaks through a resistance level, we would consider that now it's an uptrend. And one of the other interesting features about support and resistance is that one can turn into the other. Right? So if a price is falling and breaks through a support level and then falls below it, that previous support level can become the new resistance level. And vice versa on an uptrend. If a price breaks through a resistance level going up, then that previous resistance level can become the new support level. Trend lines. The next concept we will discuss are trend lines. Trend lines are another very important tool of technical analysis, and specifically charting. The purpose of a trend line is to identify particular uptrends or downtrends. Let's start with an uptrend line. What is an uptrend line? An uptrend line is a straight line drawn upward to the right along consecutive lows. Right? So if the lows keep getting bigger, keep getting higher, and we draw a line to signify that, then that is an uptrend line. Now we will go back and look at the example in a couple of slides to see how it works. But first, let's think about it conceptually. So we have a series of lows that keep getting higher, and we draw a line along these lows, and that becomes our uptrend line. Likewise, with a downtrend line, it's the same thing, but of course in the opposite direction. A downtrend line is a straight line drawn downward to the right along consecutive highs. If we see that highs are getting lower and lower, right, so the peaks are falling over time, then obviously the price is in a downtrend. And we can then draw this downtrend line along these peaks, and this becomes our downtrend line. Now, in order to draw a trend line, we need to have a couple of points in place, right? So let's take the example. Let's say we want to draw an uptrend line. To do this, we need at least 2 consecutive lows, with the second low higher than the first. So we need 2 points at least to draw a trend line, right? And the vice versa will be the case for a downtrend line. We need at least 2 consecutive highs, with the second one lower than the first, for a downtrend line. Now, while we can draw a trend line with just 2 points, in order to confirm the validity of the trend line, we need prices to bounce off it a third time. So we actually really need 3 points to confirm that an uptrend or downtrend is taking place. So we can draw a line with 2 points, and that will be a tentative trend line, okay? But a definite trend line, right, to confirm that it's valid, we need to have a third point bounce off of it. And essentially, the more points bounce off that trend line, the more valid it becomes, but we should generally have at least 3. Trend lines. Let's now continue our discussion on trend lines. Now that we know what a trend line is and how to create one, Let's talk about why they're useful and why they're important. A trend line can be used to identify support or resistance and corresponding buy or sell opportunities. So when a price bounces off a trend line, let's say we have an uptrend line, so the trend line is below the prices, and prices are hitting it and bouncing off of it. Well, that can be used, that's for example a support, right? Because prices are bouncing off of it, there's buying pressure, they're going back up. Then we can use that to create a trading opportunity, right? That can be a buy signal. Right, so we can use trend lines to find buy and sell signals by identifying support and resistance. The other thing a trend line is very useful for is to identify when the trend has changed. If we have a particular trend in place, let's say an uptrend, then when that trend line is broken, let's say when the price breaks through that trend line, that can signify a change in the trend. So much like with support and resistance, right? When the price breaks through a support, that's significant, that's indication of downtrend. When it breaks through a resistance, it's an indication of an uptrend. So the same way, if we break a trend line, we can identify a change in the trend. Now here we have another point which I mentioned before in the last slide, but I would like to talk about it a bit more. So as we mentioned, we needed 3 points to confirm the validity of a trend line. And in general, the following principle will apply. The longer a trend line has been in place, the stronger and more valid it is. Right? So a trend line that has had many times the price bouncing off it will be more valid and stronger than a trend line that has only had 1 or 2 or 3 points off of it. So that creates a stronger trend line. And the other significant thing is that the longer is the trend line, the more significant the break will be. So if we have a very strong, solid trend line that's been reconfirmed over time, when it does break, if and when it does break, that becomes even more significant, right? That can more clearly signify a change in trend. Now, one of the other tools we can use with trend lines is to apply bands. So if we're talking about breaking a trend line, we can, for example, apply a band to the break, right? So we can say that the price doesn't necessarily need to just cross the trend line, but it needs to cross it by more than X%. So for example, 1%, right? And this is done to avoid whipsaw. And we've talked about whipsaw before. So if the price, for example, is moving fairly close to the trend line and it's kind of going up and down through it, that doesn't necessarily constitute a good signal, right? So in order to see a trend line break, we may want to see the price move at least a certain percentage away from the trend line in order to identify a break. Channel lines. The next concept we will talk about is what is known as a channel line. The channel line is another tool we can use to identify trends and to identify trading opportunities. It is essentially a variation of the trend line. So what we do is that in addition to the trend line, so firstly, in order to create the channel line, we actually need to draw the trend line, like we discussed before. So we draw this trend line, and then we draw another parallel channel line. And the channel refers to the fact that whatever's in between those two lines is like the channel where the price should be. So if we have an uptrend line, alright, so remember the uptrend line will be lows getting higher and higher, so the trend line will be below the prices. Then we can draw a channel line above the prices, parallel to the trend line, and that should represent the upper bound for prices. Right? So prices will move within that band, within that channel. And likewise, for a downtrend line, because the trend line will be then above the prices, the channel line will be below the prices. And this will represent the lower bound for prices in a downtrend line. This, of course, is fairly self-explanatory and makes sense. Why are channel lines useful? Well, one, we can use them for short-term profit taking. So, for example, if, let's say we have an up channel, right? A trend line and an up channel line going up. We know when the price hits the trend line, that's a buying opportunity, right? Because it should bounce off the trend line and go back up. But if it continues up and then hits the channel line, because that represents the upper bound for prices, that becomes a short-term profit-taking opportunity. And that's why we can use channel lines. Now, of course, just like trend lines, channel lines can be broken. If a channel line is broken, that would signal the acceleration of an existing trend. So, for example, if we have an uptrend, we have the channel line and the trend line. If prices are moving up at a certain rate, they'll stay within that channel. But let's say they start going up even faster, then it will probably break the channel line, right? And that break of the channel line can signal an acceleration of the existing trend. And the same thing will happen going downwards as well. Retracements. The final concept we will talk about in this lecture is what is known as a retracement. A retracement is essentially a reversal of a prior move. Now, this is directly related to when we talked about the intermediate trend, right? So if there's a primary trend going in one direction, and after that price move, prices will often retrace a portion of the move. Okay, and that's the intermediate trend. And they will do this before moving back in the direction of the original trend. Right, and then when this occurs, we have a retracement. Now, in Dow Theory, we talked about the 50% retracement. This is one of the common ones that are occurred. So a 50% retracement means that half the move is retraced or reversed. Right, so if the price moves from 100 to 200, a 50% retracement would be moving from 200 to 150. Now, we can set a minimum or a maximum on a retracement. So, for example, we could say the minimum level to qualify for a retracement is 33%. The maximum would be 67%. That's 1/3 and 2/3. We can set these numbers differently as well. Later on in the course, we'll talk about Fibonacci ratios as one way to set these numbers. But let's for now go with what we have here. Let's go with 1/3 and 2/3. And what we can essentially know from this is that if the price reversal is greater than the maximum retracement, right? So let's say we have price going up and then it retraces by more than the maximum, so by more than 2/3, right? That will be a signal that the original trend is no longer intact. So that will be a signal that what we had is not an intermediate correction, but actually a new trend, right? A new downward trend, for example, right? So in order to qualify for a correction, we'd need to have a minimum 33% retracement and not more than 67% retracement. If we have more than retracement of 2/3, then we say this is actually a new trend rather than a correction in the existing trend. And this is how we use retracements and what they're useful for. Alright, so now again we'll go back to the example and see what it looks like. Retracements. Again, here we are back on our graph of the Nifty index. Now, what we're going to do is just show an example of where we can spot these retracements. In general, retracements are a little bit easier to calculate with an Excel sheet often. And a lot of technical charting software can draw a retracement line for you. Well, this brings us to the conclusion of our lecture. And let's just quickly recap what we've done. We first went through Dow Theory, and we learned that it was essentially the first form of technical analysis and trend following, and it had the 6 tenets. Then we talked a bit about trend, and we talked about the different types of trends, uptrends, downtrends, and sideways trends. Then we talked about major, intermediate, and near-term trends, that is, the different phases and types of trends. And then we talk about additional concepts like support and resistance, trend lines, channel lines, retracements, all of these tools to help us identify the existence of trends. Now, like we were just talking about, a very good idea is that if you could go through and practice these on charts of your own. Now, I suggest you print out the chart and do it on paper. That's the easiest way to do it. You can also use charting software, but that is a little bit less flexible because it won't necessarily allow you to draw lines wherever you want to. So I would suggest take a chart, print it out, draw some lines, see what you can learn from it. And In addition, I also want to point out a reference for this lecture. So if you look at the Murphy book, which is Technical Analysis of the Financial Markets, which is in the references, I've outlined a couple of chapters, which I believe are chapters 2 and 4, that where a lot of the material in this lecture comes from. So if you want further clarification, understanding of the material, I'd have a look at that book and have a look at those specific chapters. One chapter is on Dow theory, and one chapter is on trend. And this should give you a better understanding of it if you need it. Although if you understand everything we've done, then you should not need to worry about it. Alright, so that's the end of this lecture. Our next lecture will be on reversal patterns. We'll now apply some of these tools to actually look at patterns that exist. And we'll start with reversal patterns, which will be the next lecture.